It's looking pretty grisly for investors this year. And with the way today is going, it's completely possible we will hit official bear territory by the end of the day. What do people mean when they say bear market? A correction in the market is generally about 10%. A bear market is when the index has actually fallen 20% from its high. This is, of course, opposite from the bull market, where we see sustained increases in values over time. It's believed the nomenclature originally came from middlemen who actually tried short selling literal bear skins. But an easier way to remember the difference between the two is to actually think about how the animal attacks. A bull attacks by driving their horns upward, whereas a bear attacks by driving their paw downward. Bear markets are not comfortable for anyone, especially near retirees. But here are 4 interesting facts that may put your mind at ease. Number 1, they are normal and part of the investing game. Assuming a 50-year investment horizon, you can expect to have to weather about 14 bear markets over your investing timeline. Number 2, half of the S&P 500's best days in the past 20 years actually occurred during a bear market. This is why your advisors are always encouraging you to not try and time the market, because if you pull out during a bear market, you could miss some of the best days out there. Number 3, relative to bull markets, bear markets are generally shorter. The average bull market is about 2.7 years, whereas historically, the average bear market has been less than 10 months. Number 4, historically, bull markets are more common and more impactful than bear markets. The average bear market has a loss of 36%, but the average bull market gains about 114%. Despite the fact that bear markets are normal, expected, and generally less impactful than the much preferred bull market, that still doesn't mean we have to like them. But this bear market does have some silver lining we should consider. For one, our economy is still doing very well. Unemployment is low and consumer spending continues to be high. Many view this bear market as a much needed rest from the exuberance the market has had in recent years. The market is responding to rising interest rates and other actions by the Fed. But at the core of it, this risk appears to be relatively short term. For those of us in the accumulation phase, this bear market may be a great buying opportunity. When facing major market adjustments like we're seeing today, resist the urge to act impulsively and embrace the bigger picture. That's it for this week. This is Jeannie, the 401k lady.